Hi guys, it's Stock Curry, and the stock market went on a massive rally on Thursday with the Nasdaq up over 4% at one point. Then earnings came out and they were absolutely dismal. So where do we go from here? I'm going to let you know. So let's get into it. It was a really weird day in the stock market with the Nasdaq up over 3%, yet the Dow was actually down. Quite the disconnect, and this all has to do with the fact that stocks were rising based upon the technology companies rising. Specifically, stocks like Amazon and Google were up over 7%, and Apple was up over 3% as well. And these all help to bring the entire stock market index up for the indices where those stocks are in, specifically the S&P 500 and the Nasdaq. And that is why we saw the massive rally in the stock market today. Now, from a technical standpoint, if you look at the daily chart, it shows that the stock market is extremely overbought. We also got a gap that will need to be filled on the daily chart. All of that on the daily chart is pretty bearish, and we'll need at least one day of a pullback before we can start going back up again. And based upon the earnings that came out Thursday night, we just might get that pullback on Friday. I'll talk more about that in just a minute. But taking a look at the weekly technicals, we have now formed a W shape on the weekly, and this is an extremely bullish technical pattern, and it really points to the stock market probably going to continue to rise for the next 3 weeks. Now, in the face of everything, we take a look at the Federal Reserve, who has said that the financial conditions need to get tighter. In other words, the market needs to come down. And right now, he also said that they would not be lowering interest rates by the end of the year. The stock market doesn't believe Jerome Powell. The stock market doesn't believe the Federal Reserve. And the stock market is basically on this attitude of, let's just go fight the Fed because the Fed is lying. And we'll see how that works out. I think for the next 3 weeks, we continue on this bullishness. We rise. And then what happens in 3 weeks? Well, in 3 weeks, we get the Fed meeting minutes. And maybe, no guarantees, but maybe, just maybe, the market will read the Fed meeting minutes and go, wait a second, Jerome Powell's telling the truth. They're really not going to lower rates. And maybe they'll wake up and decide not to fight the Fed, and we'll see the stock market sell off at that point. But maybe not. Maybe the market will just continue to ignore the Fed, and we'll just continue to rise. But I think the first real chance of a downturn is going to come in about 3 weeks when the Fed meeting minutes come out. Right now, with the extreme bullishness on the weekly chart, as well as the market momentum and the market psychology right now being extremely bullish, I just don't see a whole lot of things that could slow this market down. So between the psychology and the technicals, extremely bullish right now, except for the daily chart, which is overbought and will need at least a one-day pullback before we continue higher. So where could this one-day pullback come from? Well, quite simply, earnings. Right now, the stock market is pretty much ignoring earnings, and the stock market is in this belief that earnings will go up in the future, even though they're really bad right now. However, if the stock market decides, you know what, maybe earnings aren't going to go up, maybe they will continue to go down just like they have been going down for the past year and a half now, maybe the stock market will turn around. So tomorrow on Friday, we've got a pretty good chance of the market going down because every single company that is halfway large that reported earnings after the close on Thursday, they missed earnings. It was dismal. One of the worst earnings quarters for technology stocks that I've ever seen. And yet the stocks really didn't fall that much. And that just goes to show how bullish the market is right now and why I think the stock market might fall on Friday, but after that, they're pretty much going to ignore the bad earnings and the stock market is just going to continue to rise because it just didn't fall that much after hours. And if the market was at all really looking at earnings, the market would have fallen significantly. So let's take a little bit closer look at some of the earnings that came out after the close on Thursday, and let's discuss some of these companies individually. We get started with Qualcomm. Qualcomm's revenue fell 12%, and their forward guidance shows that next quarter is going to bring more pain. Not only did Qualcomm miss earnings, revenue declined 18%. Qualcomm was down 2.5% after hours, after already falling almost 2% on the day. Starbucks also missed expectations. Starbucks earnings and revenue both fell short of expectations. Starbucks was down 2.89% after hours, after falling 0.7% on the day. However, it should be noted that Starbucks also recently hit a 52-week high. So this drop after hours is minuscule compared to how much Starbucks has been running up over the past few weeks. And this is going to be the story over and over and over again, and it just shows how extremely bullish this market is. Even though earnings continue to decline, this is sending PE ratios skyrocketing higher, meaning multiples are getting back to levels that they were at before this bear market started. And with the multiples now getting back up to extremely high levels, the stock market, fundamentally, it needs to come down. So we're in this point right now where the technicals and the psychologicals are extremely, extremely bullish, but fundamentally, things are very, very bearish. And in fact, they got even worse after these companies reported earnings today. And in my experience, what generally happens is that we will see the technicals get in line with the fundamentals eventually. The only thing we're not really sure about is how long will it take? And a lot of times it can take upwards of a few months to even a few years before the technicals get in line with the fundamentals. So the market's very, very bullish right now, but at some point the market's going to drop and get in line with these fundamentals. Moving on to Ford. Ford posted a full year net loss and an ugly fourth quarter as they said execution issues plagued their operations. Ford sold 100,000 less units than they were expecting to. Ford stock was down over 6% after hours, after rising almost 4% on the day. Now we get into the three big earnings, the Alphabet, Amazon, and Apple, the ones that everybody has been waiting for. And I got to tell you, the earnings were dismal. All of the stocks fell. But wait until you compare the fall after hours to how much these stocks rose on the day, and you will see just how bullish this market is. Alphabet missed on both earnings and revenue as their YouTube revenue fell short. Earnings per share came in at $1.05 versus $1.18 expected. Revenue came in at $76.05 billion versus $76.53 billion expected. YouTube advertising revenue was only $7.96 billion versus $8.25 billion expected. Even Google Cloud revenue was down at $7.32 billion versus $7.43 billion expected. Just an overall horrible quarter for Alphabet. Alphabet posted just a 1% growth in revenue for Q4, one of their worst quarters in years. Now, you would expect that after earnings like this, Alphabet stock GOOG and GOOGL would absolutely tank after hours, but shockingly, that's not what we saw. Alphabet was down 4% after hours, which sounds like a lot until you realize it was up 7% on the day. We got the same story from Amazon. Amazon beat on fourth quarter revenue, but missed on earnings. Forward guidance also came in light. Earnings per share came in at 3 cents versus 18 cents expected. Revenue came in at $149 billion versus $145 billion expected. And like Alphabet, Amazon was down 3.5% after hours, which is nothing compared to the fact that it was up 7.3% during the day. It should also be noted that Amazon has now reported a full year net loss, meaning they no longer have a PE ratio. Now, if you were to calculate a PE ratio just based upon Amazon's last two quarters that were actually profitable, then you would get a PE ratio on Amazon of 174. That's right, 174 is the PE ratio on Amazon based upon the last two quarters. But in reality, they don't have a PE ratio because it's non-existent because they don't have earnings. So overall, Amazon stock is now excessively overvalued. Apple pretty much had the exact same results. Apple's sales dropped 5% in its largest quarterly revenue decline since 2016. It was also the first year-over-year sales decline since 2019. Apple shares initially dropped over 4% after earnings came out, but then the company provided some really good forward guidance that was very unexpected, and that at one point brought the stock back up into positive territory after hours. Earnings per share was a miss at $1.88 versus $1.94 expected. Revenue was also a miss at $117 billion versus $121 billion expected. iPhone revenue missed at $65 billion versus $68 billion expected. Mac revenue missed at $7.7 billion versus $9.6 billion expected. iPad revenue beat at $9.4 billion versus $7.7 billion expected. And other product revenue also missed at $13.4 billion versus $15.2 billion expected. And services revenue came in line with expectations at $20.7 billion versus $20.6 billion expected. Overall, across the board, earnings per share was down 10.9% year over year, revenue down 5.49% year over year, an absolute dismal quarter for Apple. It was a stunning miss by Apple and its first earnings miss versus expectations in almost 7 years. In fact, this was only Apple's second revenue miss since August of 2017. As you can see here on the chart, year-over-year revenue has not fallen since 2019, the last time we were in a recession. Yet, Apple shares barely budged. They were only down 1.9% as of the recording of this video. They were up 3.7% on the day. So the story across the board for every single company who reported earnings was major earnings misses, significant declines in revenue and earnings on a year-over-year basis, an incredible amount of earnings misses, and a very small decline after hours. In most cases, the after hours decline was less than the during the day rise in these stocks. So horrible, horrible earnings, and yet a very bullish stock market that wants these stocks to continue to rise. Overall, the stock market is ignoring the Fed, they are ignoring earnings, and the stock market just wants to go up. The stock market does not care about earnings, they do not care about the Fed, they do not care about PE ratios. The market, no way, in any way, shape, or form, cares about any of the fundamentals right now. It just wants to rise. And for those reasons, I think we'll get a slight pullback on Friday due to the bad earnings. However, for the next 3 weeks, I do expect the stock market to continue to rise just based upon the momentum and the technicals of the market at this time. At some point, though, at some point in the next few months, the market's going to wake up, it's going to get back down to reality, and it's going to come more in line with the fundamentals, and we should see a pretty significant drop. I just don't see it happening anytime soon. I hope this video helped you guys out. I did want to let you know that on the Moomoo promotion, they've lowered it a little bit. You can now get 5 free stocks with a $100 deposit, and you get 15 free stocks with a $1,000 deposit. If you haven't opened an account with Moomoo yet, make sure you go in there and get that account open now before they lower the promotion again. Take advantage of these offers now. They remain incredible offers. And Webull also is offering up to 12 free stocks with any deposit. It used to be a $100 deposit. Now it's any deposit. You can literally open an account with Webull, deposit $1, and you can get up to 12 free stocks. So take advantage of that as well before that offer goes away. I hope you guys have a lot of success trading. If you got a lot out of this video, then be a good friend and share this video with your friends and family. And make sure you hit that like button and subscribe. And if you missed my Fed analysis from the Fed meeting yesterday, make sure you go watch the last video that I uploaded here.